Welcome, everybody, to Tokens of Wisdom. I am your host, Dave Rothschild, and today I'm very lucky to be joined by Patrick Colegrave. He is a partner in the investment funds practice at Forbes Hare, and we're going to talk all about Cayman law aspects to launching a fund. So I'm very excited for this discussion. Before I have Patrick introduce himself, I want to tell everybody, as you know, to please listen to the disclaimer at the end of the show. Nothing Patrick or I say here is legal advice, investment advice, tax advice. We're just having fun. This is for educational purposes only, so please listen and watch as such. And with that out of the way, Patrick, welcome to the show.
Thanks, Dave, and thanks very much for inviting me. I've been looking forward to this. Very quick intro on myself and Forbes Hare. So I'm a fund formation lawyer focusing primarily on the Cayman Islands. I've been doing this now for 21 years, so that's showing my age a bit. I really enjoy what I do, so if I do start rambling on a bit, just make sure to interject. Forbes Hare, we're a boutique law firm, so we're a partner-led law firm focusing on BVI and Cayman. We've been around since 2005. Our approach in terms of how we interact with our clients is a very high-touch approach. So we're all in the corporate and fund space, 20 years plus experience either in BVI or Cayman.
Amazing. So your practice of advising fund managers is old enough to drink in the United States. That's very exciting.
That's a bit depressing.
I prefer exciting. I think that's great.
Exciting. We'll go with exciting.
Well, I'm very excited to have you here. Really excited to dive into Cayman fund formation aspects. And so, I've done an episode on BVI. I had Phil Graham from Harney's talk about some of the BVI aspects to fund formation. And so a lot of my listeners have some background on why they might want to have an offshore vehicle in their structure. I guess my first question is, if I'm a fund manager, let's say I'm based in the U.S., and I realize I need an offshore fund to accommodate non-U.S. investors, why should I choose Cayman over BVI?
Okay, that's a really good question, and I'm sure it's a question that Phil gets asked quite a lot, and I get asked quite a lot. I think, essentially they do the same thing from a U.S. manager perspective. You're providing an offshore fund vehicle for your non-US investors and US tax-exempt investors. The differences are, as far as Cayman is concerned, market recognition is probably the biggest differentiator. And I say that in the context of Cayman having 80% of the offshore fund market. So that includes competitor jurisdictions such as Luxembourg, Ireland. I guess you've got the new ones as well, like ADGM, DIFC. So on a global basis, it's recognized by many of your private fund investors, your institutional investors, with a few nuances. Now, I also just want to mention that BVI is also a very good jurisdiction, and there are specific use cases for BVI where BVI is actually a better fit than Cayman. But I'm not going to go into those because I assume that Phil would have spoken to those as well.
For sure. Yeah, and I think this dovetails with what I usually tell people. I mean, I hear you say market recognition. To me, that means investor familiarity, investor comfort with the jurisdiction. I sometimes will tell clients that it might be a little bit cheaper to launch in BVI, but the Cayman Islands is viewed almost as the Delaware of offshore jurisdictions in the sense that there's never going to be an investor who questions your choice of Cayman Islands or who has some issue with Cayman Islands as a jurisdiction, whereas I think it's relatively rare in my experience that someone's really off-put by BVI or some other jurisdiction, but it's at least theoretically possible.
Yeah, I agree with all that. That's right.
Okay. So let's presuppose that we're going to form we're going to go with Cayman for this offshore fund. Okay. Let's talk high level. Does my fund always have to register with the local regulator, which is CIMA in this case?
Generally, yes. Okay. But there are some nuanced instances where that might not be the case. I would say, in my experience, 99% of the funds that I work on, both closed-ended now with the Private Funds Act, which came in, I think, about 4 or 5 years ago now, and the Mutual Funds Act on the open-ended side, the answer would be yes. Just a high-level example where that might not be the case is if, in the mutual fund context, your fund is seeded only by promoters or operators, which essentially is the directors if it's a company, and the promoters will be the people who are directly involved in marketing the fund. And in the closed-ended context, they add an additional exemption, if you like, which is a proprietary investor, which has quite a broad definition, basically to do with founders, principals, and ownership. But I think assume it will need to be registered.
Okay, that makes sense, and that's how I have always understood it. I am old enough to remember when there was an exemption from the CIMA registration requirement for funds with, what was it, fewer than 15 shareholders or something like that?
Yeah, that's right. Fewer than 15 investors, the majority of whom could appoint and remove the directors, and they've done away with that.
Yeah.
And actually, they brought in the master fund regulation to register those, which used to fall under that exemption in the open-ended context as well. So, that sort of useful get-out has now fallen away, which I think is a bit sad, but depends what side of the fence you sit on.
Yeah, I think so too, but we deal with we deal with the regulations as they are, not as we want them to be. So let's assume we're going to have to register. When I think about registering in the U.S. context, that's a mutual fund, and that's a much more involved process than what we typically think of as a hedge fund or a private investment vehicle. So what's involved in registering with CIMA? Is it as intense as registering a mutual fund in the U.S., or is it a little bit less?
No, it's not that intense of a process. Okay, it's a well-trodden path, so to speak. I think one has to think about what type of registration you're doing. So, for all intents and purposes, if you're doing an open-ended fund, the vast majority will be a Section 4.3 fund, which is a non-retail fund, for lack of a better word, where your minimum initial investment has to be more than 100,000 US. So, in that instance, you've obviously got to have your offering document, and that's where most of the work is involved, to be honest. We work with our onshore colleagues, such as yourself, in producing those. You have to have 2 directors, individuals. You can have a corporate director, but it has to have 2 directors behind it. Okay, it's called the 4 Eyes principle. And that's both for open-ended and closed-ended funds. You need to complete legal counsel will need to complete the Reefs filing form, which sets out some basic information on the fund, and Reefs filing form related to anti-money laundering. And then you need your consent letters, essentially the fund administrator broken into the NAV calculation agent and registrar and transfer agent, and the auditor consent letter. And then you need to obviously pay the fees. But that's it in a nutshell. And
so can I ask you a couple? Let me ask you a couple.
You dive into that, because I've sort of given you a shotgun blast there, if you like.
For sure, and I like the term the 4 Eyes principle. I assume that's not a dig at glasses wearers like yourself and me, but it sounds like you need 2 human beings at a director level. Do they have to be external, or could those functions be served by internal principals of the management company?
That's a really, really good question that we get asked frequently, and they don't need to be independent at this point in time. My view of the CIMA rules and guidance notes is there's a move towards having independence on the board, just from a corporate governance perspective, because the CIMA rules and guidance notes speak quite a bit to independence of the directors from other service providers, particularly from the activity of investment management, being able to make sure that when the director, if it is a principal of the investment manager, is acting as director, he's wearing that director hat. So I think the industry is moving towards having independent directors on the boards, but it's not a formal requirement yet. Okay. And one other thing just to mention on that, the question of directors before I forget, if you're setting up a mutual fund, okay, so an open-ended fund, we call our open-ended funds mutual funds in Cayman after the Act, the Mutual Funds Act, which is different to what you might associate a mutual fund to be in the US.
Sure.
Your directors need to be CIMA registered. Okay, so and that's quite a quick and easy process, but you just need to make sure you've registered with CIMA if you're going to be a director.
Okay, so it's not a regulatory requirement that the directors be independent, but it is becoming more and more common practice. And I would assume, I know from my interactions with clients that often investors will, especially more institutional investors, will expect to see some measure of independence at the board. But if you do use internal folks as directors, they're going to have to register with CIMA as a director, which is a separate and in addition to the Funds 4.3 registration.
That's correct. That's for open-ended funds. Closed-ended funds don't have that requirement, which I haven't worked out why that is. But anyway, there you go.
Okay. Very interesting. Okay, so these two directors, they have to be registered with CIMA. And then you mentioned consent letters from the administrator and the auditor. Is that just a letter that confirms, administrator X or auditor Y is actually engaged by this fund to perform those functions?
Yeah, that's essentially it. It does set out what they're going to be doing as well, very briefly, kind of like in bullet point form. And I've heard, this is going back some years now, but it's something I always keep in the back of my head, is just make sure when you describe the services of the fund administrator in the offering document that it accords to what's set out in the consent letter, because I did have a query raised on this that would have been about 15 years ago, so it's just something to sort of keep in the back of one's mind, if you like. But your auditors and administrators, now you need to have a Cayman auditor for the sign-off. Okay, there needs to be sign-off from a Cayman auditor, and all your typical auditors that you would see in the private fund context would have an office or some sort of capacity in Cayman, so that's not really an issue. So, and they have their basic forms, so it's not a roadblock to timing.
Yeah. Okay. So fill out an application, send in the offering document, have directors, auditor consent letter, admin consent letter, and I think you said pay the fee to file the application. What can you give me a sense, like overall, what is that fee? How much does it cost to register with CIMA?
Yeah. And just one other thing on the mutual fund side is you have to have a notarized affidavit regarding electronic records. But the fee is, so you pay this fee on submission of registration, okay, and that will cover you for the year that you register. And then it's an annual fee payable, if I'm not mistaken, by the end of March at the latest. I think it is for CIMA in the following year. For about $4,482. That is for both private fund and a mutual fund. And I'm not talking about segregated portfolio companies here. I'm just assuming it's a sort of standalone fund. Yeah. So that's your CIMA fee. Okay.
Okay. That's pretty steep, and that's just the fee for filing. I see. I see how it goes. Like I said at the beginning, it might be a little cheaper in BVI, but it's not too bad. Okay, well that makes a lot of sense. So that's the CIMA registration process. That's about what it costs. Sounds like from the legal side, most of the work is not in the application itself. It's more in the drafting of the offering documents and making sure that the offering documents have all the appropriate language you would need in there, which you're going to need whether you're registering with CIMA or not. And so is that an accurate assumption that the legal fees associated with actually applying for registration are not so much?
Yeah, I think that's right. I don't know if it's helpful to the audience, Dave. I can give you a sort of ballpark figure on what you might expect to pay in terms of overall disbursements. I'm talking about entity formation as well for the two typical types of vehicles that we see, which is the exempted company, okay, and the exempted limited partnership, and in the US context with a Delaware LLC as the general partner. Okay, so just a ballpark figure which would include the CIMA registration. This doesn't include professional legal fees. So for the exempted company, if it's open-ended, about 10,500, okay, to include the establishment or incorporation costs as well and the registered office, okay. And partnership, exempted limited partnership with the Delaware LLC, are you looking in the region of 15,200? And the discrepancy is because you need to register the general partner, which is the Delaware LLC, as a registered foreign company in Cayman.
Oh, wow. Okay.
Yeah.
So that's much higher than the cost of forming an entity in the U.S., right? I mean, usually in the U.S. you pay something like $500 to Delaware to form the entity. Maybe it's $800. I don't remember offhand. And then you register, you file a form to qualify to do business in whatever states you're actually operating in. And it's probably a similar charge on a state-by-state basis. But that's more than a comparable U.S. entity. And is that an annual amount that you have to pay every year, or is that a one-time setup fee?
That's a really good question. Again, it's more for the one-time setup fee. So in terms of ongoing fees following the initial year of incorporation, establishment, and registration, I think for an exempted company, you're probably looking at in the region of sort of 8,000 US, okay. And for the partnership, probably in the region of about 10,000 US, maybe slightly less. I haven't actually got those actual figures to hand, but I think that's about right.
Got it. Okay. Understood. And that leads perfectly into my next question, which is, what are the common entity types for a Cayman fund vehicle? It sounds like there's the exempted company and the exempted limited partnership.
Yeah, I mean, those remain, certainly in my experience, the two common forms of entity. And the nuance to the exempted company is the segregated portfolio company, okay, which is increasingly more popular. I mean, I'm seeing more and more of those cross my desk, and it does make sense where you're going to be running a range of funds, but just to set up an SPC with one segregated portfolio on the basis of having one initial fund and the hope that you're going to have more in the future might be not have the economies of scale and the cost benefits that you would otherwise have.
Yeah. I think it's worth double clicking on the SPC for a second, because so a segregated portfolio company, this is like a special kind of exempted company that can issue, it's almost like, I always analogize it to series vehicles in Delaware, a series LLC or a series limited partnership, where they can offer, new series where the liabilities of each series are ring fenced from one another, statutorily. In the Delaware statute that creates these entities, it says if you set them up and operate them properly, then creditors of one series cannot reach into the assets of another series to satisfy debts of series one. Is that essentially what a segregated portfolio company is, just in the Cayman context?
Yeah, I mean, that's a really good analogy. And I mean, often we see in the sort of master feeder context, and I'm thinking of one client of mine in particular, they have I think it's a series LLC onshore vehicle, and then as the onshore feeder, and facing that is the SPC Cayman vehicle, the offshore vehicle, and that feeds into a Cayman SPC master. So the concept's the same. I mean, segregation of assets and liabilities at a statutory level.
Yeah, understood. Yeah, and I kind of feel the same way that I think you were expressing there a moment ago. If you're starting with one fund and you might have more funds in the future, it might be more cost and trouble than it's worth to set up an SPC at the start, but every client has to figure out what's best for them.
Correct. Yeah.
Okay, so assuming we're going to choose either the exempted company, and I always describe an exempted company as, what we in the States would call a corporation. It issues shares, it has directors. An exempted limited partnership looks like a limited partnership here. It has LP interests. Is there one choice that's either better or worse, or how should I think about choosing between the two?
So typically in the US context, we would see the exempted limited partnership used for closed-ended funds, okay? And the exempted company used for open-ended funds. Now, I have seen, and this is sort of looking at things from a global perspective, not necessarily the US, but I have seen an increasing use of exempted companies in the closed-ended context, okay? And the sort of headline issue in doing that is how do you do the capital accounting, okay, for at the level of each investor if you've got a closed-ended fund. So, and also with the side letters and what have you, to avoid having a differentiation of class rights coming about because of various side letters. So certainly how I structure exempted companies where they're closed-ended is each investor will get its own share class, okay, which sorts out the capital accounting issue and also gives you flexibility for side letters, or a subclass, which in effect would be, from a Cayman law perspective, a new class. So yeah, but in the US, invariably, in my experience, closed-ended fund, we can expect to be setting up a limited partnership.
Got it. Yeah, and I kind of see the same. I think headline level, I see more closed-end funds that are setting up a Cayman vehicle use a limited partnership, and open-ended funds use an exempted company. It's interesting hearing your description. I've never really understood why that is the case. I mean, from my perspective as the onshore lawyer who's often drafting the first cut of the offshore documents, it's a little bit easier for me if it's a limited partnership because, a lot of the terms that you're using in your onshore documents, you can carry over to the offshore documents. It's like limited partner here, limited partner there, instead of limited partner here, shareholder there. But I'm curious, going back to the CIMA registration point and the Four Eyes principle, if you have a limited partnership, does it still need directors that are registering with CIMA, or is it something else?
No. So obviously if it's a limited partnership, you've got your GP, okay? So CIMA looks behind to, who's, and let's talk about a Delaware LLC here, okay, as the general partner. So CIMA will say, okay, well, who are the members of the Delaware LLC? Who are the managing members? And you need to have two ultimately within the structure, because you might actually have and I've seen this a few times, where you've got the GP, which is an LLC, then there's another corporate entity, which is the GP. But ultimately you need to get two individuals, okay, who are managing members or what have you. And just to reiterate again, closed-ended, CIMA registered private funds, those people won't need to register with CIMA as directors. Now that raises an interesting question, and I don't want to digress here. I did warn you about this before at the beginning, Dave. And
Please digress away.
I have seen a couple of exempted limited partnerships set up as open-ended funds, and there's no reason from a pure Cayman legal and regulatory perspective why you shouldn't do that, okay? Mm-hmm. So assuming that you do that, you've got your GP, do the managing members of the GP need to register with CIMA as directors or whatever it might be? Now, that's something I would need to look into. I don't know the answer off the top of my head, but I will assume yes, that would be the case. Yeah.
Okay. Well, that makes sense. I mean, I think like a lot of what we've talked about, starting at the beginning with Cayman versus BVI, and it being, really about investor comfort at a certain level, and then LPs, exempted limited partnerships versus exempted companies. I think it often, in reality, it comes back to what do your investors expect? And, humans, we're kind of like sheep. We like to do what other people do. And for whatever reason, open-ended funds are usually exempted companies. So investors in open-ended funds want to see that structure. They want to know that there are independent directors. And even if there's not a regulatory requirement, common industry practice will drive people toward doing what everybody else has done so that they don't stand out, so that investors don't ask questions about why they did it differently.
100%. I agree with that 100%. A lot of what we do is investor driven,
Yeah. Okay. So moving along, I'm curious about other very high level, local regulatory requirements for a Cayman fund. We talked about the CIMA registration, the directors, we talked about the audit consent letter, so I assume an audit is required for these funds. A few other things in my mind are all of the multi-letter acronym officers, your AML officers, your CRS officers, your MLROs. Can you touch on those a little bit?
Yeah. So and a lot of this would be handled by the fund administrator, So having a fund administrator who's familiar with administering Cayman funds is really helpful. And your fund administrator doesn't need to be based in Cayman. I mean, most of them aren't, to be honest. But the principal officers outside of the directors would be the ones that you mentioned, which I sort of loosely term the compliance officers. So you've got your anti-money laundering compliance officer, so AMLCO for the acronym. Then you've got your money laundering reporting officer, MLRO, and your deputy money laundering reporting officer, so your DMLRO. Wow.
It's a lot of letters.
A lot of letters. Your money laundering reporting officer and your deputy money laundering reporting officer, because one is a deputy, can't be the same person. But you can have a single person acting in one of those functions and also as the anti-money laundering compliance officer. And that's all prefaced by them being suitably qualified and informed to perform those functions.
And so you're saying that most funds will use their outsource these functions to their fund administrator?
Yeah. I mean, even if there's some fund administrators who don't do this, and in those instances, we would recommend a service provider who can provide those services, because otherwise it's quite a heavy regulatory burden if you have to go and familiarize yourself with the regulations and everything and get yourself to a level of competency to perform these functions. And then there are the FATCA CRS functions as well, which again we typically see performed by the fund administrator and very high level principal point of contact and person. Yeah, so those two as well.
So are these roles often held by the actual fund administrator? Or does the fund administrator appoint individuals to hold these roles? Like, can it be a corporate entity, or does it have to be humans?
You can have a corporate entity now for the compliance officers. Okay. And you can have a single corporate entity, if I'm not mistaken, performing two of those roles. And then you need, I think it's an individual performing the third role. The FATCA CRS ones would be individuals. So the administrators would typically, the ones that I've seen, they appoint individuals. They have specific people within their organization who perform these functions and perform them for all the funds that they administer, the Cayman funds, I should say.
Okay. Well, that all makes sense, and it relieves me that I, as a fund manager, don't have to wear all those hats myself.
No. I mean, you need to stick to just managing the portfolio as much as possible if you're the fund manager.
Yeah, absolutely. But I guess this underscores the point that you need all kinds of stuff to have a Cayman fund, and so it the costs can add up, I suppose.
Yeah, very much so.
Is there any local presence requirement? If I'm let's say I'm a U.S. fund manager and I'm starting a Cayman fund, do I need to have any local presence at any point?
No, you need to have a registered office in Cayman for the entity. But other than that, and the audit sign-off, so I mustn't forget that. Yep. But other than that, you're good to go.
And when you say audit sign-off, I guess it's worth a quick chat on that. I know you mentioned earlier that you need to have your audit signed off by the Cayman office of whomever your auditor is. Is that really just a kind of check-the-box exercise? Or are they performing another audit? Like, I'd assume that they're just looking at what their main audit office did and rubber stamping it, but maybe I'm wrong.
You might get me into trouble here, Dave.
You can tell me I'm wrong.
Okay, so a number of the audits themselves are actually done in Cayman by the Cayman auditors themselves. But where there's a US auditor, they get the sign-off. And my understanding is that the Cayman auditor reviews the audit that has been prepared by the US auditor and ensures that there is compliance with the Cayman requirements. So you're not doing two audits as such, no. And the costing is generally, as I understand it, reflective of that. So you either have an auditor who's in Cayman, say, I won't name names because I don't want to do that, but whoever you can think of, their Cayman office doing everything, or you have their US office doing everything and either the correspondent in Cayman signing off or their Cayman office signing off. Yeah.
Got it. It's more than a rubber stamp and it's less than a second audit.
Correct. Let's leave it
All
at
right.
that.
I love it. All right, so let's switch gears real quick and talk about your practice. Do you work with all kinds of fund managers? Are there any that are, specifically exciting for you?
Yeah, so I'm strategy agnostic. My background, if you like, I started off as a funds lawyer in London, in the city. That's probably going back to, I think, 2000 now. I was at one of the big international firms in their investment management practice, and they primarily focused on closed-ended. But whilst I was there, we started doing hedge funds. And that's where I sort of got an interest in Cayman as well, because I saw, Cayman keeps coming up and I wanted to look into that because funds, I enjoy funds law. I couldn't be a fund manager because I'd lose everyone's money. So what can I do to stay close to the industry? I'll be a funds lawyer. And then I moved to Cayman in 2004 or 2005, I think it was. And then I was doing primarily open-ended, that was pre-crash. So, wow, we had a lot going on, and it was really quick and easy then because you didn't have this huge regulatory overlay. Yeah.
Mm-hmm.
So strategy agnostic. However, there are certain strategies where Cayman is not suitable. And I think of one in particular because I did have an instance where this crossed my desk. That was probably about 2 years ago, which is cannabis funds. And we looked into that and cannabis funds. I actually approached CIMA on a no-names basis for this and said, would you be prepared to sign off on a cannabis fund? And then the message I got back from CIMA was no. So gaming funds, whatever a gaming fund might look like, and I haven't really got my head around that, but anything to do with gaming might be problematic as well.
Cannabis just because it's illegal in so many places?
Yeah. It's the legality of cannabis in Cayman. So, and I'm not aware of that position having changed, but I might be wrong.
Okay, very interesting. And then how do you charge for your services? Is it usually flat fees? Do you charge hourly? Is it something else?
In a fund formation context, I usually go on a fixed fee basis just because, I've got a good idea from the outset what I think it's going to cost. And that gives certainty to the client, certainty to us as well. So we don't have this back and forth on fees when you come to the end of the launch of the fund. And then we do have certain assumptions, which, would be your standard assumptions, if you like, that we build into that, just to protect us in case, there's a curveball or something. Yeah.
Well, that makes sense. And then, okay, let's say I am a fund manager. I'm starting my offshore fund for the first time. I don't know anything about Cayman or offshore law firms. What should I think about when I'm choosing the right provider?
Yeah, I mean, that's another good question. Things I would think about is experience. Okay, who you're actually going to be dealing with on the fund on a day-to-day basis, who you're going to be interacting with. The other thing to think of, which is really important, is, is there a good personal fit between yourself and the lawyer? Because obviously you're going to have an introductory conversation, and if you don't get a level of comfort from the lawyer, well, then chances are it's not the right person you should be speaking to. I certainly don't reference cost, when choosing a lawyer. I mean, some people are more cost effective than others. Some firms are more cost effective than others, and that's okay. That's fine. But that shouldn't be your main driver. I think that's kind of a bit of a dangerous road to go down, to be honest.
Yeah, I agree. I mean, obviously cost is important and you need to stay within your budget, but assuming you're, selecting from providers that are in the same ballpark, I don't think, it makes the most sense to just choose based on price. Okay, so my last question for you is going to draw on your multiple decades of experience advising private fund managers, but what is the smartest thing a new manager can do when they are setting up a fund to set them up for success? Okay,
so I'm looking at this in the context of the US, okay? And US managers. Okay. And remember, there's a specific need for an offshore fund when you're a US manager. Most US managers don't actually need an offshore fund, okay, because they are raising money domestically from US taxable investors. So my advice in that regard is, do you actually need an offshore fund? Because you don't want to spend a lot of time and energy and cost in setting something up that you don't actually need. So, and that advice would come from people such as yourself, Dave, in the first instance,
Yeah, of course.
is this right for you? Assuming that the answer is yes, okay, then make sure that your capital, your seed capital for the offshore fund is fairly secure. It's not a sort of, a hope check that you are expecting to come through. The other piece of advice, which I think is very helpful, is before you push the button, and this is a bit of interaction between both onshore counsel, primarily onshore counsel, I think, and the manager, is be certain of, or have a good certainty of what your fund terms are going to look like, because you don't want to change gear, if you like, sort of midway through the process. And I did have an instance where I was working with US counsel, and we were working on it was a closed-ended fund. It was a partnership, and midway through, the sponsor decided no, he thought it should be open-ended, and that was like, wow, okay, so yeah. That's just blown our budget out the water and changed everything. So having a clear
good thing you put those assumptions in your in your fixed fee engagement letter.
That's right. But having a good idea as to what you actually want is important. So those are the two sort of main headline items I would highlight.
I love that, and especially the second one. I tell clients this all the time when they ask, give them a quote for what I think it's going to cost. I usually bill hourly, but I tell people what I think it's going to cost, and then they ask questions like, well, what are some things that might go wrong that might make the cost spiral? And that's always my first answer: is make up your mind and stick with what you've made up. Otherwise, we're going to have to redo everything. And going from a closed-end fund to an open-end fund or vice versa, that's a totally different set of documents. And so that's, you're going to end up paying probably double the cost.
Yeah, that's right.
Well, excellent. Patrick, thank you so much for joining me today. I think I'm much more knowledgeable about Cayman requirements and practices, and I really appreciate it.
No, thank you so much, Dave. I've really enjoyed this conversation, and I didn't babble on too much, I hope. So thank you once again for having me. It's always great to speak to you, and I'm really happy to contribute to your podcast. Thank you.
Thank you. Okay, with that scintillating conversation out of the way, we can get to the part you've all been waiting for. The legal disclaimer. On this show, my guests and I discuss laws, regulations, and aspects of fund management from a 10,000-foot view. And nothing I say here, nothing my guests say here is legal, investment, or tax advice. Everything we say is our own personal opinion. Nobody is speaking on behalf of their employers on this show, and it is entirely for educational purposes only. If you're thinking about starting a fund or you're curious about what's involved, this show is a good resource as you explore your options. But if you're going to pull the trigger and actually launch a fund, please engage professional service providers to assist you in the process.